Hi there, I am Sean O'Toole with Exercise Your Options, and we're starting a series of strategy episodes, option strategy episodes, where we talk about particular strategies and how they work and how they make money, how they lose money, that sort of thing. And I think it makes most sense to start at the absolute beginning, which is single-legged option strategies, just buying calls, buying puts, etc. And so here we start with buying calls. Now, before we get deep into this, there are a couple of terms and conditions we need to talk about. We're not going to go deep into the Greeks, the risk metrics of options during this series. We will do that later, but I think it makes sense to talk strategy first, then come back to risks. But what we do need to talk about are just some of the standard terminology so that we're talking the same language. First is option strike. When I talk about an option strike, what I'm talking about is the price at which the underlying asset changes hands. If I'm a buyer of calls, I have the option but not the obligation to purchase an underlying asset, be it a futures contract, stock, whatever it is, at the strike price. So we're going to talk today about 550 calls. 550 calls give me the right but not the obligation to purchase, in this case, soybean futures at 550. Simple as that. We also talk about expiration. Options are a limited lifetime vehicle, and we're going to be talking in this episode about specifically three different time frames just for comparison purposes. We're going to talk about 90 days, 45 days, and 5 days until expiration. In addition, we're going to talk about out of the money, at the money, and in the money options. An at the money option is an option that's trading at or right about its strike price. So if the underlying is trading at 550 and the strike price is 550, the 550 call is at the money. If, however, we're trading at, say, $5 and the strike price is 550, that's considered out of the money. The option has no underlying worth whatsoever. If we went to absolute time of zero, that option would be worth zero. Now, the opposite of that is an in the money option. And let's take move it out to, say, $6. So let's say the underlying is at $6 and the strike price is at 550. That option would be in the money by 50 cents. In other words, if the option were to expire today, it would have a value of 50. It would have a value of the underlying price minus the strike price. If that number is a positive number, it is in the money by that much. So, with the basics covered, let's go into a little bit of why one would trade call options. Most call buyers are typically looking to reduce the overall risk of a trade. In other words, if I'm buying stock or buying a futures contract, there is potential that could ultimately go to zero. Not likely, but so if I'm buying soybeans at 550, I risk a lot of downside there, and I can use stop loss orders. I can just watch the market very closely and exit a trade if I'm losing money. But what a lot of traders will do is they will instead buy a call option that simply has they're paying cash for it. It's not a margin transaction. And so if that 550 call option costs them, say, 20 cents, 20 cents is the most that they're going to lose. So they think of it almost like a stop loss order. But the beauty of it is it lasts. If they leave that options position open, they have time all the way until the expiration of the options contract for the market to appreciate in value and effectively bring their option into some sort of a profitable picture. So they could go down dramatically and then come back up and still make something on the option. That's just one reason why someone would use a call option. Another but reason it's probably the most frequent traders will use call options is in a strategy I'll call a lottery ticket strategy. This is a situation where there's a relatively low probability that a market will move, but if it does move, it's got substantial potential for substantially higher prices. An example of this would be springtime. Planting is coming along, and we know that the corn crop and the soybean crop, if it gets hot and dry at the right time, will have a substantial chance of rallying in price. We don't know much about that now in terms of the weather picture, but things can develop. So traders will put on these so-called lottery ticket trades where they buy a deep out-of-the-money call option for just pennies on the dollar. And if the market takes off and runs up through their price or even just near their price, but with lots of time value left in the option, they will see substantial gains in their investment on sometimes several 100% on a low-priced option. So they pay a nickel for an option, they sell it out at 15 cents or 20 cents. Now this is typically done with option expirations that are longer than 90 days. Traditionally, in the case of, say, soybeans, they're trading the new crop cycle soybeans, which is the November contract expiring in October, and they're going to put on that trade in, say, April or May or something. So they've got a lot of time for that to work in their favor, and they're buying stuff that's $2, $3, $4 out of the money sometimes, and just loading up and buying a whole bunch, leveraging up. In the off chance that we have a big year in soybeans, that kind of a trade can be worth just a ton. So that's another usage of call options. And really, in my opinion, if you're trading out of the money call options, that should be your strategy. Trading under long time horizons and looking for lottery ticket type moves. Trading out of the money call options as an investment strategy is really quite poor. And in the next video, we're going to go through and talk a little bit more about why that is, and we're going to show some relationships between at the money, in the money, and out of the money options, call options specifically, and how the risk return parameters change over a period of time from 90 days to expiration. So we'll see you next time.